Hey friends, it's Nicole Berry with the Berry team and eXp Realty. And today I want to speak to you a little bit about two different kinds of mortgages. You've got adjustable rate mortgages and fixed rate mortgages. And so when you speak to your mortgage lender, they're going to share more information about each one. But basically, they're kind of self-explanatory. Adjustable rate mortgages have interest rates that adjust over time. And so you may start with a low mortgage rate, but as interest rates rise nationally or for different reasons, those interest rates may change. They may go up or down over time. No one knows how much or when they may change, but usually you start off with a low one, and then over a few years afterwards, you may see a change in your mortgage rate. So that's the first option, is an adjustable rate mortgage. The other option is a fixed rate mortgage. So those are going to just be the same rate throughout the entire loan, and that is going to be the rate that you lock in at. So when you are speaking with your lender, he or she is going to talk to you about just making sure that you get locked in at a specific rate. Because every day our rates kind of go ebb and flow. Sometimes they change dramatically in just a few weeks. Sometimes they don't. So when you're going through that process of seeing how much, they're going to give you an idea as to what the rate is, but until you lock in, you don't have that rate until you lock in. So make sure you lock in if you're doing a fixed rate mortgage. Now, a couple of different options to think about and consider when you are trying to decide which one you should go with. Number one is, how much can you afford each month? So if you have a budget of what you can afford and you are already at the top of your budget, what's going to happen if you have an adjustable rate mortgage and the interest rate goes up? That's going to change your payment monthly, and it's going to change. Now, of course, no one knows when that's going to happen. So it may happen in 5-6 years. You may have a different job, better pay. You may have gotten a promotion. There's lots of different things that you can't really predict. But to stay safe, you want to think about it at your current level. So what can you afford, and can you afford if they do go up? Your lender can show you a little bit more about how much you could expect it to go up, or what it could look like if you go up. And she could even crunch those numbers for you. So that's your first thing to consider. The second thing is to consider, how long do you intend to live in the home that you're purchasing with this mortgage? Because if you only plan, maybe this is your first time home buyer, this is your starter home, and in 3 to 5 years you fully expect to have a few more children, and you'd like to upgrade into the next bigger home for you. If you only plan to live in the home a short amount of time, then adjustable rate mortgage might be a good situation for you, because you may be able to enjoy that lower rate for the time that you're in the house. So consider that as an option. And then the third thing is, how do you anticipate interest rates to change or continue? So right now we're in September of 2019, and interest rates are at historic lows. They're in like the 3%. So that's awesome. But I would imagine in the next 5 to 10 years that they are going to go up, because when you're at the bottom, there's only one way to go. So consider that. And again, speak with your mortgage lender, because they are going to be the experts on helping you to find the best kind of loan for your situation. Again, this is Nicole Berry with the Berry team. We are in Concord, North Carolina, Charlotte, North Carolina, all the surrounding areas, and we would love to get you connected with a mortgage lender to get you started on that search, to help you figure out which loan is best for you. And then we'd love to help you find your dream home. Remember, our teamwork makes your dream work. Have a great day.